let's discuss notes receivable a bit. First thing, let's talk about how we recognize notes receivable. Now, let's differentiate between short-term and long-term notes receivable as well. Because generally when we talk about short-term notes, these are recorded at face value, less any type of, allowances when we talk about net realizable value. Because the interest that we're looking at for short-term notes is, when we talk about implicit interest for the maturity value, it's usually is immaterial because of the term of the note. So the general rule is that we treat these almost as cash equivalents. So again, we're talking about things that are short term. And so we don't subject them to things like discounts and premiums and amortization of those discounts and premiums. But long-term notes, then we want to treat these and look at these as far as time value of money is concerned, and look at the present value of the cash that they're expected to collect. So when we look at long-term note recognition, think about when we've discussed time value of money and our bond proceeds. When we talked about figuring out how much we were going to have for our bonds, same kind of thing that we're going to do here for notes and notes receivable. Now we're on the receivable side. Okay, receivables and payables, it just depends on what party you're looking at. We're talking about them from the receivable side this time, but the process is going to be similar. So we recognize we have to see, just like we did with bonds, okay, are these notes being issued at face, or are they being issued at something other than face? And in reference to that, we're also looking at interest rates, okay, just like when we looked at bonds. Did we issue them at the stated interest? Was the market rate the same as the stated rate, or was it different? Okay, so that's all going to have an impact. If you issue the notes at the face value, then you're going to literally record them for the same amount. Now you can do a time value calculation on this, but you're going to come up again to the same thing. So this is where you've got your stated interest and your market interest is the same. So let's say they're both, 8%. Then this is going to be issued at face value. So if it was a $100,000 loan, then you're going to have notes receivable debited for $100,000 and cash credited for $100,000, and you're going to record your interest payments each time. Okay, and that's going to get paid back to you, that $100,000. Okay, that's issued at face. Now, when you have notes that aren't issued at face, there's a couple of reasons or a couple of ways we can recognize those depending on the circumstance. So let's flip. Okay, so let's say it's not issued at face. Well, that could be because we have a zero interest-bearing note, we have an interest-bearing note, or that has difference in interest rates, or we have a note that we've issued in exchange for property, goods, or services. Okay, so there's a couple of reasons why, or things that might be going on, that we haven't issued the note at face value. So if you have something called a zero interest-bearing note, then the present value is the cash that's paid to the issuer. So you know the cash that was paid, and you know the future value, the actual face of the note, so we can compute what's called an implicit interest rate and figure the interest rate out. And that's just going to show us that difference between, or we're going to record the difference between that face value, which is, again, the future value, that's what we're going to receive in the future, and whatever the cash was that we were paid, which is the present value today. That difference is going to be our discount or our premium that we can amortize over the term of the note. Again, this should spark some memories of when we did this with time value money and bonds. If not, you might want to go back and look at those. Okay, but you should have a good handle on how to calculate those, how to get present value. Now, we're not getting it right now, but we will in a minute with interest bearing, but how to calculate present value of individual amounts of annuities to get the interest payment, combine them, get a total amount, and then figure out the difference between the face and that number to get the premium or the discount. Okay? And then also, just like we did with bonds, again, we're going to amortize that premium or discount so that the carrying value eventually becomes the face of the note or the maturity value. Okay? Exact same types of things we did with bonds, because bonds is a type of debt, or bonds are a type of debt, sorry. So, okay, zero interest bearing, there you go, you would record the note receivable at the face, and you would record cash as the amount that you actually received, and you're going to take the difference to figure out if that was premium or discount. If you got more cash in the face, you got a premium. You got less, discount, okay? And again, you can calculate or figure out that implicit interest rate based on those differences. If you have an interest bearing, so it does state an interest, it's an interest bearing note, then a lot of times you might have it where the stated rate and the effective rate of the market rate are different. Okay, again, think back to bonds. You keep on referring to that because all of this is calculated the same way. So this is where, let's say your stated rate is 8% and the market rate is 10%. Okay, or your stated rate is 8% and the market rate is 5%. If you have that, then you're going to have a discount or a premium with this. You're not going to be issuing it at face value because the stated rate and the market rate or the effective rates differ between the two. And again, we talked about how we'd automatically know. Let's give my examples again. If your stated rate is 8% and the market rate is 10%, okay, then you should know, again, think back, did you get a premium? Would that note have a premium or would it be at a discount? Okay, and vice versa. If the stated rate is 8%, market rate is 5%, premium or discount. Okay, first one you should have a discount, second one you should have a premium. So again, you're going to have those differences. You're going to be able to calculate using time value of money, just as we did before, to get the present value of the note, and the difference will give you the discount or the premium. And then you're going to amortize that discount or premium based on that effective interest method. Okay? Again, we did all this with bonds, so it's the exact same thing. If you don't remember that, then go back and review those things we did with the bonds. But it's the same process, but now we're just looking at notes, okay, instead of bonds. Just a different type of debt, different name, but the same process that we did before, okay? Now, another thing that you can have where you don't issue these at face is if you're exchanging them for property, goods, or services. So let's say you give a note in exchange for land, you give a note in exchange for a piece of equipment, for some inventory, for you provide services, and you receive the note. So again, several different examples you can give for an exchange here. And one thing that's important, and you'll see this referred to, it has to be an arm's length transaction. So it's not like, you and your brother got together and figured out, hey, I'll just swap this out and, everything's cool. So again, it has to be arm's length. Then when we try to figure out the interest rate, as long as it's arm's length, we know that that's fair, okay? But might have a few hiccups with the exchange as well. And I don't remember, let me see if I put these on the next slide. Oh, no, let me go back. Okay, so still on the exchange here. So we've got three things if you've got no interest rate stated, okay? If the stated interest rate is something that's just wild or crazy or unreasonable is technically the term you use here, but some unreasonable rate. So there is something stated, but it's unreasonable based on the current situation. Or you've got the note face, and it's very different from either what you could have as a fair market value of that same note, or something that's very different than your cash sales price of whatever these items are that you're exchanging. Okay, so if those exist, then we've got to measure the present value a little differently than we did before with stated rate versus the market rate and those types of things. Okay, so we've got to figure out some kind of an amount that would approximate this value for us, some reasonable amount. And we're going to do that by looking at the fair value of the property, the goods, or the services that we're exchanging these for. Okay. And I'm just going to talk about this now. Look for some other videos with some numbers. I'll do some calculations, some examples, okay? But we don't have that interest rate, so we're going to have to look at what have we exchanged and how can we figure out an actual value based on what we've exchanged, okay? That deals with recognition, but what about the valuation side? Okay, again, short-term, long-term, a little different. So for short-term, net realizable value. So you're looking at the face amount of those, and you're taking away any allowances that may be incurred or on the books for that. So that's our net realizable value, the difference between those two. And again, this is the same that we looked at for trade receivables for your allowance account, for valuing bad debt expense, looking at doing those with percent of sales, with analysis of receivables. All those would, again, be the same thing here for short-term notes. Now, for long-term notes, you can look at fair value, and FASB is going to require us to, for these long terms, we're going to disclose the cost of them, but we're also going to need to disclose the fair value of these in the notes to the financial statement. And also, FASB does give the option that you can actually use fair value as the measurement of these in your financial statement. So you can just do this as a disclosure or a note to the financial statements, or you can actually use fair value as the basis for valuation on the face of the financial statements themselves. Okay, if you do this and they choose the fair value option, then you've got to stick with it. So if you choose to do it, then you do it. If you choose not to, you can't. Okay, so you're not flip-flopping back and forth. But when you do the fair value option, what's going to happen is you're going to look at those notes and you're going to find the fair value for them. And if you have any type of differences, then you're going to have unrealized holding gains or losses that you're going to have to record. So you'll look at these in subsequent periods and you're going to look at what's the fair value of these, what's the carrying amount of the notes, and that's what your comparison is going to be. So if there's a difference between the carrying amount and the fair value, then you're going to recognize that. If the fair value is higher, you're going to have an unrealized holding gain. If it's lower, you're going to have unrealized holding loss. Again, you do this each period to compare and get those changes in fair values. Another item that you'd want to consider with valuation is impairments. Okay, we've discussed impairments before, but a receivable could become impaired, and this is when you're not going to expect to collect all of the principal and interest for the notes. Okay, they could be impaired, kind of similar to uncollectible, I guess, but a little bit different here. So if this is the case, we're going to take a loss on these, an impairment loss. So you'll have to calculate the amount of the impairment. I'm not going to get too detailed with how we do this. If you want to know more about impairments, look in the text. We've got additional information on impairments of receivables, but just know that that's another issue that could be considered with valuations on these notes. Disposition of notes. Okay, so sometimes notes receivable can be disposed of, and I'm not talking about they just, they're paid and they go away. No, we do something differently. Okay, it's not that I have a note and I'm just waiting, I get paid for it, and then it's gone. No, okay. But for various reasons, the company may decide before that maturity, before it's paid off, to get rid of the note some way, shape, or fashion. And there's two ways they can do that. You can do something called a secured borrowing, or you can actually sell the receivables. Okay? Again, a lot of reasons why you may do this. You may need money and you don't have other good financing options. So you could, again, do one of these types of dispositions to get cash for your receivables. You may just need to pledge these for financing. Okay, we're going to talk about some difference here, but there's several reasons why a company may do a disposition of your receivables. So let's say, oh, excuse me, let me go back. Let's talk about secured borrowing because that one's the easier of the two to discuss, and I didn't give you a separate bubble here for that. So with secured, this one's where you're using your receivables for some type of a collateral in a borrowing situation. So you go to get financing and you pledge or you assign, those are the two terms that you'll see with this, your receivables for part of your security of that borrowing. Okay, so again, literally, secured borrowing, you are securing a borrowing with these receivables. Okay, it's a type of collateral to do that. So again, you can assign these, you can pledge these. They're very similar in terms. The only difference between these when we talk about them, assigning versus pledging, is who actually collects the money associated with them. I'll tell you about that in just a second. But when you do a secured borrowing, you'd go in and say, hey, we want to borrow, $1 million or what have you. And we're going to assign our receivables with this note. So it's like collateral. If you've ever taken out a loan, I'll give you a house mortgage. That one's really easy. Or a car. Many of you probably have purchased a car. Or maybe some of you. Or a home. When you purchase these on financing, okay, you get a loan for it from the bank or credit company, then that asset is in turn collateral for the loan. So if you don't pay your car payment, they will come and get your car. Car was collateral. Or if you don't pay your house payment, they will foreclose upon your home and you will no longer live there and they will own the house. Okay? So, same kind of a thing. You're securing some type of financing, borrowing, loan with the receivables. So, if you secure it with them, you assign it, then you're just saying, hey, if we don't pay this, then you can have these receivables. Okay? Or you're entitled to the money from these receivables. If you assign it, you keep possession of them and you collect them as usual. So your customers didn't actually know any difference was going on. If, however, you pledge them, then that changes who has custody of these. And so then the bank would actually collect them and send you the money. They wouldn't keep it, but it would go through them so that in the case that you fell through, they'd already have possession of them, kind of thing. So again, that's just the difference between the terminology of assigning or pledging securities for a borrowing of this nature. The only other issue with secured borrowings, usually your creditor is going to assess some type of a fee or I guess you could call it a finance charge based on the receivables and discount your note from that up front. Okay? Other than that, business as usual. As long as you pay it off, then no harm, no foul. Nobody knows any different. Okay? Now, sales of receivables, a little bit different. Now I'll click over to our next one. So when you actually sell receivables, then you could do something called factoring of receivables. Okay? When you factor these, a company buys your receivables for a fee and then collects them directly from the customers. So it's literally like if you had $20,000 and you factored them to a factoring company. They're going to purchase them, they're going to take a percentage off of that they don't give you in cash, and then they try to collect them from the customers directly themselves. Okay? Factoring receivables. Another way that you could sell these or transfer receivables would be something called securitization. And this takes different types of receivables and it actually pools them. It pools assets, different kinds. So you could be talking about, again, all kinds of different mortgages. We talked about mortgages and car loans. Those could be in here. Could be, credit card receivables. It could be a wide variety of receivables. And then what they do is they put these all in these little pools or packages or bundles, however you want to say it. And then we sell shares in these types of securities. We make securities. Financial crisis dealt with mortgage-backed securities, similar to what this is discussing. Okay, so you have a lot of investors involved, a lot of people involved with these. So, difference between factoring and securitization would be that your factoring is talking about one company. Usually you have pretty high fees with factoring, and also you are usually dealing with lower quality receivables for factoring. Okay, and with securitization, you have a lot of people involved. There's a lot of investors involved with this. You have really small margins on this. Most of the time, the receivables are better quality, though. Now, again, financial crisis, we had some issues with those types of securities. Those did deal just with mortgages. And usually, also with these, you've got a seller that continues to service the receivables, whereas with factoring, that's not the case. They don't continue to service those whatsoever. Okay, so factoring, securitization, two different ways. With both of these, though, you can do this with recourse or without recourse. Okay, or vice versa. I've got them listed vice versa. Sorry. So you can factor without recourse. You can factor with recourse. You can do a securitization without recourse or with recourse. Okay, so let's talk about what exactly that means without recourse, with recourse. Nope. See, I forgot how I did. Okay, I'm just going to flip y'all back and forth a couple times. Sorry. So if you do a sale without recourse, okay, just think about it's not going to come back. Anyway, that's what I like to say. So if you purchase without recourse, then whoever buys these assumes risk with these. So if you purchase something without recourse, that means that if I can't collect it, then guess what? I just can't collect it. If you're the company and you sell those receivables without recourse, then whatever money you get from that company, that's what you're going to get. And you don't have to worry about paying them anything, or if you know, those receivables, they can never collect them, they're going to come back to you and you have to pay something. No. Okay? You sell it, whatever price that is that you sell it for, that's what you get. You're done with the receivables. You wash your hands. It's all over. If you sell with recourse, however, then whoever's selling those guarantees payment of those debts to the purchaser if those customers don't pay. So if I sold all my receivables of, you know, $50,000 and some of those were not paid, then I'm guaranteeing payments. They're going to come back to me and say, hey, you owe us money for these that we couldn't collect. That's a sale with recourse. Okay, so very different in who has risk for those two. Also different on how we would calculate the loss, because when you're talking about selling receivables, you're not going to have a gain with these. No one would purchase them and pay more than the receivable. So you're gonna have losses when you do these. But how we calculate the loss is a little bit different. Again, I'll do some calculations in a separate installment, so look for that. But that's what we're talking about if we say sale without recourse or sale with recourse.